Hey everyone, welcome back to More Than Commas, where we explore the deeper principles behind money, decision making, and building a life that's meaningful to you, not just profitable. I'm your host, Paul Adams, CEO and founder of Sound Financial Group, and today we're diving into a topic that shapes investors' behavior far more than people realize. And we're going to look at why financial media and influencers predict market crashes far more often than these crashes actually occur, and how that disconnect harms you as an investor. If you've ever noticed that financial headlines warn about a disaster every few weeks while your long-term portfolio continues to compound, this episode is going to make a lot of sense. Now, before we begin, make sure that you like, subscribe, and if you're listening to the podcast, leave us a review. As we go, comment below with some of your feedback. We love hearing your feedback. And here's our first question. We'd love to hear from you in the comments. Have you ever sold out of fear because of a headline, or did you ever get close? Now let's start with the undeniable reality. Financial media and influencers issue crash warnings constantly, far more than any of these major market declines actually occur. But this isn't just a casual observation. Multiple academic studies across behavioral finance, media analysis, and investor psychology constantly show us the same pattern we were able to identify with our AI-assisted research. You see, these crash fears are wildly disproportionate. While the 15+% downturns rarely ever happen, they only happen every 5 to 6 years on average. But here's the mismatch. The media warns us constantly. Why? It's because negativity drives engagement. Even back in the days of watching TV, the most important thing to the news network was the ratings. The ratings are what they sell to their advertisers. That's right. When you're watching a TV program, you are the product. That's why you're getting the financial stuff on TV for free. And that hasn't changed a bit in the era of social media, except it's lowered the bar with which it takes somebody to come out and be an influencer or a predictor on yours and many other people's finances. Now, these outlets, because they're measured by the engagement, you will see negative headlines 2 to 3 times more often than any positive ones. And humans have this weird ability where we will take a risk and we will way blow it out. It's called availability heuristics. And it's this concept that the economists Amos Tversky and Daniel Kahneman had come up with. It's that when we're frequently exposed over and over again to the markets about to crash, our brains assume it's more likely. Despite the fact that those crashes aren't happening, just hearing they are going to happen over and over again actually puts us in a position where we inappropriately think that they are more likely than they are. And these influencers, that's our third, they need to stay relevant. Nobody builds a YouTube channel or newsletter saying, stay diversified, stay consistent, save more money. None of that. They do grow fast by saying, hey, you better get out of the market. There's a reason to panic. You're going to be wiped out by what's coming. And the crazy thing is that this works, even if they do it every year and they're wrong. Now, fourth, predictions don't need to be correct. They just need to be clickable. You see, accuracy doesn't drive any of the traffic that's out there. Drama does drive the traffic that's out there. But before we get on to our next topic, I want your thoughts. Do you personally see more positive or negative financial news? And have you seen a particularly negative headline lately? This episode is brought to you by Count. It's a modern platform specifically built for bookkeeping and accounting professionals. To learn more, find the link in our description below. You get a 2-month extended trial and free migration of your clients if you chose to choose Count. Now let's look at what the research actually shows. We're going to walk through some key studies that when we put these together, you really see a powerful pattern. Our first study is, man, I'm going to get this name wrong, Getzman, but the title is Crash Beliefs from Investor Survey 2017, National Bureau of Economic Research. So this was a 26-year analysis. Here are the highlights. Investors estimated a 19% chance of a major market crash in the next 6 months. 19% chance. And what was the real probability? 1 to 2%. And what they concluded is that media directly increases crash fears. And this will blow your mind. Positive media didn't reduce fears anywhere near in symmetry with the amount that negative news impacted it negatively. And the authors concluded that investors consistently overestimate crash risk by a factor of 10. And it is amazing how much people worry about these things versus how often they happen. Then we have Boria et al. The title was Crash Fears and Stock Market Effects, 2019 from Applied Economics. And what they did is they just did Google search volume index and used that data to correlate with the news of the day. And they found crash-related searches spike 4 to 6 times a year, even with small pullbacks. Only 20 to 25% of those spikes actually happened during a genuine 15% downturn. Most of the things that were out there were considered false alarms, only leading to a 5 or 10% temporary dip, and markets reversed quickly in most circumstances. In fact, 70% of the fear events where the market actually dipped recovered quite quickly. And it once again reinforces that the fears are often, the crashes are rare. Then number 3, Engelbert and Parsons, it's the casual impact of media in financial markets. That's 2011. But this one was specifically TV news. Negative segments increase selling activity by 15 to 30%. You might say selling activity like, oh, somebody went on and did that kind of selling activity cost investors millions and millions of dollars, cost many people their retirement altogether because they responded to what the news media said they should do with their investments or financial influencers said to do with their investments rather than implement disciplined financial philosophy. And the thing is, we discover is only 1 in 5 of these media-driven panic moments align with real downturns. And it's a realization that the media can move investors, but not in ways that help them. Now, here's the historical market data of this. Across nearly a century, the stock market rises in over 70% of the calendar years. True, 15% plus declines only happen every once 5 to 6 years, and recoveries happen most of the time before investors feel comfortable getting back in. You see, you line up all these studies, and the pattern is totally unmistakable. Crash warnings appear constantly, and the crashes are only occasional, and we have no evidence anywhere that somehow pulling your money out of the market at the right time and then putting it back in at the right time is at all predictable or achievable to do. It's like, wouldn't it be nice to be able to fly? Yes, I would love that. Or be bulletproof. But we don't have any of those things right now. And we don't have any way to know when we should move in or out of the market. There is no way to know. It is right up there with saying, I would like to fly to work, because in every academic study, when both professionals and individuals attempted to do so, they did not end up with higher returns than they were going to get had they just stayed invested to start with. So why does this matter for real people investing their money? What do you do about the drumbeat of fear that's constantly coming at us? Well, one of the best things you can do is understand what we call the doom cycle. And it's just a predictable sequence that always damages long-term financial outcomes. I'm going to say that again. This doom cycle is a predictable sequence that damages long-term financial outcomes every time. So the doom cycle starts with you hear a scary prediction. And then as a result of that scary prediction, you say to yourself, like, it's the market went down and it's going to go down further, or this happened or that happened. Then after that, they either reduce equity exposure, owning less stocks, or maybe they get out of stocks altogether. Then step 3 is they miss the recovery, right? Because nobody catches that bottom. So they didn't get their money back in. The market's gone back up. Oftentimes we see the market come back 10, 20, 30% before somebody says they want to get back in. And as a result of missing that recovery, they fall behind their long-term goals and ultimately end up not being able to retire in anywhere they wanted to, or any of the circumstances they would have chosen when they were in their 40s. And then 5th, and this is the worst part of the doom cycle, you rarely hear somebody that's not ready for retirement saying, you know what, I made some bets I shouldn't have made, and it cost me and my family our entire retirement. You never hear that. What you hear is, oh, it was the market. The market did it to me. It was the blah-de-blah of the crash of whatever. But if you've been investing, academically allocated, globally diversified over long periods of time, even if a crash happens during your retirement, your plan should have included that and be able to weather that storm. For instance, one of the things we do is we make sure, to the best of our ability, our clients can distribute at least 7 years of money, their income in their old age, 7 years before they have to sell a stock, because we want to keep that long-term mindset. You see, the problem is, in all of these scenarios, in that entire doom loop, the market wasn't the problem. It's always the reactionary behavior. And this is like the most expensive behavior in personal finance. It doesn't matter how many lattes you buy, if when you've got millions of dollars in a portfolio that you make that move that produces you totally missing a recovery, maybe not being in the market for 5, 6, 7 years, you never underperform because of the crash. You underperform because you reacted not to that crash, but you reacted to all of the predicted ones that never happened. And think about how stressful your investment experience is. If you're constantly questioning your investment philosophy, despite the overwhelming academic data that the only thing possible to do when markets roil is to rebalance, stay patient, stay disciplined, and get the returns over time. And even though that's what every bit of evidence points to, there are plenty of people willing to market to us that we should be moving our money around. And they all that are doing it somehow are profiting from it. And so what you can do is anchor yourself in decisions and principles, not other people's predictions. And that's going to be things like evidence-based investing, broad diversification, having that long-term discipline, ignoring all of the noise, and then have a philosophy that's rooted in scholarship, not sensationalism out there. And this is exactly what we do with every financial institution that we do business with on behalf of our clients, is staying grounded in principles, because the noise isn't going away. All you can do is become immune to it. Now, this episode gave you some clarity about money or about markets or about how to react to them. Then send this to somebody you care about. We know if they're an undisciplined investor, there's some likelihood the close friend you're going to text this to won't be able to retire with you if they're not being disciplined also. So share this with them. And we want to hear from you. What's the worst market prediction you have ever heard? It could have turned out to be true or not true, but just what's the worst one you've heard? And as always, don't forget, we'd love you to like, subscribe. We love our More Than Commas community and enjoy this journey with you. And in our next episode, we're going to go a little deeper into one of these major financial influencers, and I'm just going to call them out on 15 years of absolutely failed predictions. And I'm not going to be nice about it because Corey's not with me today. So I hope you look for that next week. And why don't you get back to living a great life?